Hello, everybody. This is Professor Tchaikovsky, also known as, or Bennett Tchaikovsky, also known as accounting professor here on YouTube. We're going to go through and look at some accounting problems today. It should be fun, not only fun, but fun and exciting. But before I get there, this presentation is copyright 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any redistribution is expressly prohibited without my prior written consent. And most importantly, any opinions, terrible jokes, anything expressed herein are those of myself only and do not represent those of Irvine Valley College or the South Orange County Community College District. So let's go ahead and jump into our question right over here. So we have on March 1st, 2025, YYZ loans SNA $200,000 at an annual rate of interest of 6%. The loan and interest will be payable on February 28th, 2028. And let's go ahead and duplicate. Excuse me. There we go. So be payable on 2/28/28. Assume there is no interest on interest, and the amount of interest payable will be on the loan amount only during the time the loan is outstanding. So for SNA, so we are basically for where the person is receiving the loan, prepare the initial entry for the receipt of the loan on March 1st, 2025. Now, if you've watched the other videos, if we kind of know going through that, oh, okay, we've got our assets equals our liabilities plus our owner's equity. ERDC, right? This is really important, right? So for assets, they're typically going to have debit balances. They're going to be increased with debits, decreased with credits. Liabilities and equity accounts typically have credit balances. They're going to be increased with credits, decreased with debits. We would generally record expenses with debits, and we generally record revenues with credits. Whenever you make an entry, those are the things that need to happen. So on 3/1/25, we are receiving cash for 200,000. And for every debit, I need a credit. And over here, I'm going to be crediting loans payable. So I'm going to credit loans payable, and this is going to be on 3/1/25. Okay. So this should not be a surprise to you at all. The only thing that's different is that in the last examples we were going through, everything was happening on December 31st, but this is different. So we're now starting this on March 1st, 2025, when we receive the loan. Now it's asking me using T accounts to prepare the adjusting journal entry. Okay, so this is our first foray into adjusting journal entries. Now, when it comes to adjusting journal entries, we're generally asking ourselves the following, or we have a couple different rules for adjusting entries. Number one, do our revenues reflect what we have earned? Do our expenses reflect what we have used? And number three is that do our assets reflect their future economic benefit? And do our liabilities reflect our future obligations? And the last thing we're going to be asking ourselves, or the kind of the rule is, when preparing, adjusting journal entries, we never adjust cash. Now, if there's an error, that might be a little bit something different, but for our all intents and purposes, you never touch cash. So let's go through and look at what's happened here. So prior to this example, when we were going through, we recorded the loan. Hopefully that makes sense. If it doesn't, please go back and watch the other videos that I prepared earlier. kind of in this latest series. I'll link them down below. But when we were going through and doing this kind of question earlier on, we kind of had this timeline. And in the course of doing the timeline, we basically said that, okay, the loan was made on 12/31, say 24, and we are preparing our financial statements on 12/31/24. So it's happening at the same time. When we look at adjusting entries, and this is why having that prior foundation to even getting into adjusting entries, if you can't record this, it's okay. Go back and look at the prior examples. But when we talk about adjusting journal entries, right, really what we're talking about as well, we're in kind of a different situation, because over here, my loan was made on 3/1/25, and I'm preparing my financial statements, or I'm asked to do an adjusting journal entry on 12/31/25. So over here, we have, well, in the words of a vice presidential candidate for 2024, we have a passage of time. Sorry, couldn't help myself. The passage of time. Okay, we'll show this in a Venn diagram. I'm an equal opportunity offender. Okay, so we made the loan on March 1st, 2025, and we're preparing our statements on December 31st, 2025. So we have a passage of time. Okay, so in this case here, when it comes to a loan payable, and we can also call this LP or L/P, not to be confused with a record. So not that any of you would know that what that is, but it's okay. So we have L/P, right, has been outstanding from 3/1/25 through 12/31/25. So my loan has been outstanding for this period of time. So if a loan is outstanding, what do I have to pay? Well, the lender is going to charge me interest. Okay. So to show the use of the money when I have a loan payable, what I'm going to need to record is an expense to reflect the use of the money from 3/1/25 through 12/31/25. When it comes to borrowing money, the adjusting journal entry is always going to be the same. To show the use of the money, I'm going to record an expense. And in this case over here, this is going to be interest expense, right? So how do we record expenses? We're going to go through and record expenses with a debit, right? So I'm going to go ahead over here. I'm going to be debiting this interest expense. Now for my credit side of the entry, right? Even though I'm getting, I need to show the benefit of the money, the interest is not going to be paid until 12/31. Actually, it's not going to be paid until 3/2/28/28. So because that interest is not going to be paid until that date, I still technically owe it, right? So I need to accumulate that interest. So over here, because I've used it during that period of time, I'm going to be crediting interest payable. Interest payable is a liability. I show an increase to my liability over here with a credit. So whenever we borrow money, if we're asked to do an adjusting journal entry, it is always the same. We're going to debit interest expense and we're going to credit interest payable. If I have a loan, right, and this is really, you want to memorize it or you want to write it out a bunch of times until it feels right. But this is what you're going to be wanting to do. Now, in terms of going through and figuring out, it says at an annual rate of interest. Whenever you see an interest rate, Unless it says otherwise, assume it is an annual rate, meaning for a full year. So over here, how do we figure out our full year of interest? Well, the loan amount is going to be 200,000. The annual interest rate is going to be at 6%. So the annual interest, or for a full 12 months, is going to be $12,000. Now, for us, as we look at this over here, right? Well, did we use the money for the full 12 months? And the answer is, well, when we look at 2025, the year started on 1/1/25. We made the loan here, and now we're getting the financial statements at the end of the year. And this is where it pays to go through and to count it out. How many months did I use the money for? March, April, May, June, July, August, September, October, November, December. I used the loan for 10 months. So what I'm going to do over here, so let's just kind of go through and see this. March, April, May, June, July, August, September, October, November, December. I know this is painful, but that's why you can put me on ×2 speed. Sadly, there's probably not a faster speed. So it's for 10 months. So the amount of interest expense we're going to go through and record. So basically from 3/1/25 to 12/31/25, this is going to be times 10/12. So my interest expense is going to be 12,000 times 10 divided by 12. Now, if you're looking at this and saying, dude, do I really have to, if you're taking my class, do you have to show that much work? The answer is no, you don't have to. I do need to see some computations, and I do give partial credit if you're taking my class. So that's a way of looking at it, but this is what you should be doing. I over explain things intentionally so where you see where every number comes. So I'm debiting interest expense, and I'm going to be crediting interest payable. So that would be our adjusting entry. And I'm doing this on T accounts. If I was asked to go through and to prepare this as a journal entry, how would I do it? Well, if we're going over here and so the way I would do this is to make a journal entry. I need a date, 12/31/25. And I'm going to go ahead. I'm debiting interest expense for 10,000, right? Debit, credit. Like a journal entry is basically the T accounts, a little bit different over here. So interest payable, that's being credited now because I'm indenting over here. I have to indent the account description. Okay. Now, the only thing that I'm missing, I need basically, this is really coming from the T accounts, right? All I'm missing is a description. Is this going to basically record interest expense? Now, if this was really for a company, would say on the loan received from or the loan received from YYZ. But for all intents and purposes here, I'm okay with you going through and leaving it like this. Now, this next question is interesting. Okay, so how are the interest and loan classified on the balance sheet as of 12/31/25, as of 12/31/26, as of 12/31/27? So when we look at a balance sheet, and this is going to be kind of what we're going to be going through and doing from this point going forward. So if I go and look at a company like Apple, when we have, oh God, okay, hold on. There we go. They do exist. Let's take a look at Apple's balance sheet. When we look at their balance sheet on the earlier examples I was giving you, I was just listing out the assets. That's just the way we learn accounting, but now you're a little bit more advanced. When we're listing out assets and liabilities, we need to list them as either current or non-current. Does that mean electrified or unelectrified? Dad joke number one. No, it basically means that, well, current means we're going to be using it or we're going to be using it within the coming year. Non-current means beyond a year. Property, plant, and equipment is always going to be non-current. There's one exception, but that's intermediate accounting. Over here, for current liabilities, what's current or non-current depends on when it's due. If it's due within the next year, then it's going to be a current liability. So it's got to be payable within 1 year from the balance sheet date. So let's come over here and take a look at this over here for us. So kind of going through and using a similar timeline. So here we're at 12/31/25, 12/31/26, and we'll just call this 12/31/27. Okay. So, and let's remind ourselves, the loan is going to be repaid on 2/28/28. Okay, so for as of 12/31/25, right? So over here, as of 12/31/25, the loan plus interest will be a non-current liability, right? The reason is the only time I would be classifying this as current is that if it's from 1 year of the balance sheet date. So as of 12/31/25, it's going to be a non-current liability. But what happens on 12/31/26? Well, in order it as of 12/31/26, in order for this to be a current liability, it would have to be due by 12/31/27. But it's not due then, it's due more than a year out. So as of 12/31/26, the loan plus interest will be a non-current liability because the due date is beyond 1 year from the balance sheet date as of 12/31/26. Now, if we come over here to 12/31/27, and I'm looking at this right over here, boy, oh boy, this is going to be a current liability. Why is this going to be a current liability? Because it's within 1 year of the balance sheet date. So over here, as of 12/31/27, the loan plus the interest will be a current liability. All right. Now, extra credit. How would we go through and prepare entries? It's good stuff. So let's kind of go through and do it. So right over here. So as of 12/31/25, my interest payable balance was 10,000. By the way, this is extra credit if you're taking my class. So yeah, it's extra credit. So my interest payable balance was 10,000. It's really important because what's going to happen with expenses, revenues, and dividends, those are going to be closed out to retained earnings, right? Because those are showing what we're using, what we earned, or what we paid out as dividends, or what we declared as dividends over a period of time. So with interest, with a liability, that doesn't get closed out. That's going to carry over to the following year. So right over here on 1/1/26, the ending balance from here becomes the beginning balance for the following period. So that interest payable is basically going to carry down from over here. Now, during 2026, how much interest did we go through and have? Well, if we go through and look at this, the amount of my interest, well, the loan amount was 200,000. My interest rate is 6%. Now, this is a very unique question because I'm not doing the interest on interest. It's not a part of this question. That's what normally would happen in real life, but we're kind of doing this so we better get a better understanding. So my interest expense is basically going to be for 2026 is going to be 12,000 because it's a full 12 months, right? Beforehand, this was only for 10 months, but for 2026, it's going to be for 12 months. So I would be debiting interest expense for 12,000 and I would credit interest payable for 12,000. So over here, my ending balance of interest payable is going to be 22,000 on 12/31/26. Now, in terms of going over here to our next one, what happens on 12/31/27? Well, on 12/31/27, and we'll say this was 12/20/26 interest expense. Okay, so on 2027, remember interest expenses, revenues, and dividends will all be closed out. On 1/1/27, when basically this will get closed out to retain earnings, 1/1/27, my interest payable or the beginning balance is going to be 22,000. So whatever my ending was of the prior period becomes my beginning for the current period. And so then need to record another $12,000 of interest. And so right over here, so my ending balance for interest payable on 12/31/27 is going to be $34,000. Now, when it comes to the loan repayment, again, this is extra credit, right? So this is if you're taking my class, be extra credit. So the thing I need to do prior to the loan repayment is I need to record. Let's pull this up here. Okay. Prior to the loan being repaid, I need to record interest expense up until the loan repayment. So, okay. Wow. So coming over here, when I go through and do this again, the ending balance as of 12/31/27 becomes my beginning balance as of 1/1/28. So coming over here, I've got a balance of 34,000. Now in 2028, it's kind of a little bit unique. In 2028, I'm paying off the loan, but I'm paying it off on 2/28/28. So the loan is effectively outstanding for 2 months. So coming over here, the amount of interest expense, so my loan amount is 200,000. My interest rate is 6%. So the annual interest is going to be 12,000. However, in this case here, I'm only need to record it for 2 months, January, February. So I'm going to multiply this by 2/12. So the amount of my interest expense is basically going to be right over here is going to be $2,000. Now, when it comes to going through and paying back the loan. So this is my balance of my interest payable, or the amount that I owe the lender on that date. So if we look at the loan payable, right, this balance has effectively carried over each and every month. So I'm going to do this. Hold on. Okay. So my loan payable, right? So every single period that hasn't really changed. Like every year, it basically said, okay, it went from 200,000 to 200,000. I'm showing the increase effectively of the loan payable through the interest payable, but basically on 2/28/28, the balance here is going to be 200,000. And if we think about it, right, I owe effectively for this loan, what am I going to have to pay back? I'm going to have to pay back the loan and the interest. And when we look at this number, this loan was effectively outstanding for 3 years, or from 3/1/25 to 2/28/28. So when I pay off the loan on 2/28/28, in order for me to go through and to pay off this loan, what has to happen? Well, what's going to happen is that, first off, when I pay off a loan, basically this loan payable is going to need to go to zero, right? Because when I pay off the loan, that's what happens. And so I'm going to decrease the liability with a debit. I'm also going to decrease this liability with a debit. Okay, so right over here, I'm going to do the same thing. So right over here, 36,000, right? So the amount of cash, right? So my liabilities are decreasing because I'm paying it off. So my cash is also going to be decreasing. So my cash is going to be credited for 236,000 on 2/28/28, right? 2/28/28. Basically, that's what's happening. If I looked at this in terms of doing it as a journal entry, you could go basically loans payable 200,000, interest payable 36, and then you'd have cash going for 236. Now, this also assumed that I basically debited interest expense and I credited interest payable. There's also another way I could actually do this, because this is assuming that I went through and basically, hold on. So this entry here on 2/28/28 assumes that I went through and I made this entry first, that I basically recorded interest expense of that 2,000 basically for that period of time up to the date the loan was paid off. Then I'm showing this over here. Now, could I combine the entries if I were to do it like this? Sure, I could debit interest expense for 2,000. I would debit loans payable for 200,000. I would be crediting cash for 236. But over here, though, because I'm recording it simultaneously, my interest payable would not be 36. It would actually be 34,000, because I'm basically combining these two. So effectively, the interest payable, when you net these out, it's a $34,000 debit. Again, you can do it either way, but that's how we're going through and looking at this one today. So that's a lot of information for one video. So I'm going to call this one part one, loan payable. And then I'm going to come back and we will then look at this new question over here with a loan receivable. So again, what I just showed you down here, I consider to be pretty advanced, but I look forward though to see you on the next video. That's why I'm calling it extra credit, but I look forward to seeing you on future videos. Have a great rest of your day, and I will see you on the next video. Have a great one.